Welcome to Multiple Perspectives. I'm David Lofgren. Today we're diving into one of the most powerful and yet often overlooked tax strategies in real estate investing, the 1031 exchange. This tool allows investors to defer capital gains taxes, reinvesting their full proceeds, and then compounding that wealth over time. But beyond the technical aspects, mastering this strategy can mean the difference between slow portfolio growth and a lifetime of tax-efficient investing. To break it all down, I'm joined by Dave Foster, a 1031 exchange expert, a real estate investor, and a tax strategist who has spent the last couple of decades helping investors keep more of their profits. Dave is the executive director of the 1031 Investor and has helped thousands of real estate investors navigate the complexities of these tax deferral strategies. But beyond his expertise, Dave has a fascinating personal story. By strategically using the 1031 exchange, he built a real estate portfolio that funded his dream of living on a sailboat with his family for a decade. His journey is proof that understanding the tax code isn't just about numbers, it's about creating financial freedom. Dave, welcome to Multiple Perspectives.
Thanks, David. It's awesome to be here.
You know, your story is a pretty unique one, not just as a real estate investor and a tax strategist, but as someone who sort of built a real estate portfolio that specifically allowed you to sort of achieve financial freedom. And in your case, what that looked like was living on a sailboat with your family for a decade. I'm wondering if you can just sort of take us back to the moment when you first, maybe realized that a traditional career path is not what you were looking for, and, sort of what that turning point was that set you on the path that you're on today.
Oh, absolutely. I remember it to the exact minute. It was 8:21 p.m. on December 29th, 1996. We had our first child. And my wife and I were both in, fairly high profile, high pressure cooker careers. And when that little guy came into life, everything changed. And we realized it was the most amazing transition, because we realized that the greatest commodity that anyone has is not power, prestige, or wealth, because you can always get more of those. It's time. Time is the one thing we cannot get more of. And all we wanted to do was spend the rest of our time just looking at this little bundle of joy. I mean, we threw the TV away. We stopped answering phone calls. We wanted nothing to do except just hang out with him. And as part of that realization, we saw that there was an incompatibility with the traditional lifestyle. And I get it. I'm the guy that has a dream who's just too dumb to know that you're not supposed to really go out and do it, because I just started trying to do it. We wanted to find a way to get off the 9 to 5 so that we could maximize the time with our children as they came. And somebody on some date night said, let's just become real estate investors. It'll be easy. Yeah, and that started the long, slippery slope. So I am also known as Ready, Fire, Aim Dave. So I just went and bought a duplex in Denver and fixed it up, rented it out. Later, I sold it. And I thought that we had made a pretty good start on our sail away dream. And then my accountant said, by the way, you got to write a check for $30,000. And that just did not seem, that was not part of the plan, because that was going to put a cramp in everything. It still haunts me to this day, because that was 30 years ago. If I would have had that $30,000 to make the interest on for myself for 30 years, can you imagine what I'd have right now? Compounding that?
It's painful when you put it that way. Yeah.
It is, but yet so true. But that was when we discovered the 1031 exchange, which allows you to sell investment real estate and buy new investment real estate without having to pay the tax. You still owe it, but it's indefinitely deferred, and you get to make the money off of that deferred tax. Well, that changed everything again. And we were able, within 10 years, to move our portfolio from Colorado to Connecticut to Florida, to buy a 53-foot sailboat with tax-free dollars, because we combined it with the primary residence exemption at each one of those stops along the way. And so we had a free sailboat, and then we lived off of the income from our vacation rental portfolio. And that was how we were able to raise those kids for 10 years on a sailboat. Greatest time of my life.
Incredible. Now, I mean, I imagine, you know, it's easy to breeze over and say 10 years, bam. But in those 10 years, you know, you made a lot of choices. There were a lot of moments when you thought, okay, maybe we should, whatever, pick up and move to Connecticut. Maybe this is the right building to purchase. You know, talk to me about the process of making those choices. And, you know, is there a point here where you think, maybe this is the wrong path? Maybe we've just made a critical mistake.
I'll come back to that one at the very end of this discussion.
Okay.
But no, you're absolutely right. One of the things that I talk about many times over and over with investors is the idea that there is nothing greater in terms of giving you power than planning. It doesn't matter if the planning results in a totally different path. You know, if you remember the proliferation of investing clubs, why did they exist? Because they let people pretend. We could discuss it. We could plan. We could pretend I have $1,000 to invest. What should I invest in? And then watch how that would play out in real time, so that then when I have the real $1,000, I can make the choice that I know I need to make. So it's really all about planning, because with the 1031 exchange, the power of it is the deferred tax. But deferred tax only works if you can keep it deferred, because it's compounding interest. So like Albert Einstein called that the eighth wonder of the world. At what point in time do you need to give up the compounding? Because now it's time to buy the asset, the sailboat. At what point in time? For us, the strategic element was, and it's kind of funny, we picked a day, and it was literally December of 2006, or 2005. And we picked that day that we were going to step on the boat and cast off the anchor line. So then what we had to do was work backwards from that. Now, December, as you and I will know, in most of the country, means that there's snow on the ground and it's not fun. In Colorado, that's what that meant. So in order to set foot on the sailboat in December 2005, we had to get to ice-free water. So the move to Connecticut seemed natural, and we started planning and working towards that. But then once we got there, we realized Connecticut's got winter.
Sure.
And Long Island Sound is never warm, and the sun never shines.
Sure.
So we went, well, okay, darn it. Well, we got 2 more years. Let's head to Florida. So, and we realized December in Florida, the perfect time to bring the sailboat down. So it's those little things where you set a course, but then you adjust. Well, okay, the sailing metaphor, you set the course and then adjust the sails to where the wind is blowing. So you've got to know your macro environment. You've also got to know internally where you're wanting to go. And believe me, every date night, every moment you can spend, every second with a spreadsheet are really going to help you get there.
Wow. That's interesting. So not just sort of making a plan with the expectation that your plan is going to work out step by step, but it sounds like what you're saying is the action of starting to make a plan and revisiting that plan, even if things change over the course of the plan, it's the practice of planning that allows you to be successful in the end. Is that right?
Well, that's exactly right. As a matter of fact, one of the lacks that I see in so many younger investors now, I mean, particularly those who've been investing since like 2011, 2012. Come on, we can do no wrong, right? You just throw money
Right.
in a property, it's going to appreciate. We're all geniuses.
Right.
Everybody has already forgotten 2008 and 2000 and 1988. But the way to overcome that is you set your course and you look at your probable results, not just the I can't lose results. You look at the best probable case, and then you've got to look at the worst probable case.
Right.
And then you've got to continually examine the environment to see, which way am I leaning?
Right.
And adjust from that.
So I think, 1031 exchanges are something that you counsel people on. You help them figure out how to achieve this tax strategy. And I'm sure you'll say it's much more than just a tax strategy. I'm wondering if we're going to spend some time talking about this today, if you can just give us the sort of elevator pitch, quick version of what a 1031 exchange is. What do people need to know about this in order to unlock the rest of the discussion we're going to have?
Let's do this. Let's approach this as the 4 Ds of 1031 investing.
All right. I like it.
All right. The first D of 1031 investing is the word defer. Because with a 1031 exchange, you're selling investment real estate anywhere in the country of any type that you either have a lot of profit in from appreciation or that you have taken a lot of depreciation benefit from. Because that's a nasty grant from the IRS. They let you take depreciation to lower your taxes, but when you sell the asset, they make you pay it back. That's just not cool, but that's what they do. With the 1031 exchange, you get to avoid both of those events. And as long as you own the new property, as long as anytime you sell that property, you do another 1031 exchange, you will continue to defer the tax indefinitely. So why is the first word defer? Because that's the compounding of interest. You get to make money off of the tax you didn't have to pay. And then you get to make money off the money you made on the tax you didn't pay. And we can literally show an example in 4 transactions over 20 years where 2 investors do the exact same thing, except one does a 1031 exchange. And the investor that does the 1031 exchange, so they're able to buy more real estate, has over $12 million in their real estate portfolio, whereas the other investor who simply paid the tax as they went has $4.5 million. Over 20 years. That's substantial. So you want to start and get that compounding effect immediately and hold it as long as you can. Now, the second D I'll give you, it's also defer. Because the 1031 exchange, the power of it is that it allows you to react as a normal investor to whatever the real estate market is telling you. Is it time to move from a particular sector into a different sector, from single family to multifamily? You can do that with a 1031 exchange. You can go from one property to multiple properties. You can go from multiple properties to one property. You can go from one area of the country to another area of the country. Anywhere you see that it is a good investing opportunity. Maybe you were in San Francisco and around about 2014, 15, prices started to stagnate a little bit. Well, it was time to maybe move with Elon and 1031 exchange down to that sleepy little town of Austin.
Right.
Where they capture a whole new market that had appreciation to unlock. If you're stagnated with appreciation, go buy in Omaha, Nebraska, where cash flow is king. But it's not exactly going to be appreciation heaven, is it? So all of those types of things you can do as part of your regular investing. But by simply adding the 1031 exchange in, you get to keep that first D of tax deferral. Okay, what do you think the third D of tax deferred investing is?
If the pattern holds, it will be defer.
Exactly. Here's why. In the same way that you can react to wherever the real estate cycle is, you can also react to wherever you are in your personal journey. Many people don't take that into account, particularly when they're starting out, because we got all kinds of energy and we just know this is going to be the way that I'm going to invest and make it big. But they don't realize that who I am today is not who I'm going to be in 5 years. You may start having children and you realize, wait a minute, it's time to start making family memories. So why don't we 1031 exchange into vacation rentals that we can use some ourselves and start to build family memories? When you're early on, you've got less brains and less money and plenty of energy. So you don't mind these value-added projects. Buy a single family, fix it up and rent it. But after a bunch of those, you start to realize, I got more money than energy. Let's start looking a little more passive.
Sure.
Let's start buying multifamily projects where there's less management involved. As you continue to grow older through your life cycle, you start to think about retirement. The retirement is where we really were able to capitalize on things, because the primary residence rule lets you sell a property that you've lived in for 2 out of the previous 5 years. And you get to take the first, if you're married, $500,000 of profit, tax-free. What a lot of people still don't know to this day is that you can do that once every 2 years. That's huge. So for us, by combining in Colorado the 1031 exchange and the primary residence, every time we sold a primary residence, we took that $500,000 and put it in the buy the boat kitty, tax-free. And then we would 1031 our investment properties. Where did we 1031 to? Where we were going to, air quotes, retire. So our portfolio was waiting for us in Florida. And we did another thing that was really cool. We don't have a lot of time today to talk about it, but it's called a conversion, where instead of taking the tax-free dollars and buying a new primary residence, we would convert an investment property that had tax-deferred dollars in it and use that as our next primary residence.
Which is then eligible for the primary residence?
Back when we did it, it was the full amount. Now you get a proration.
Okay.
But you still get to convert some of the tax-deferred to tax-free.
Wow.
What a crazy gift that is. And that's all because you're planning your retirement appropriately. Example, I have a realtor in St. Pete Beach who bought 3 identical beachfront condos, side by side, literally same floor, with his 1031 exchanges. He then, after renting one for 2 years, moved into it. No tax event. All the taxes still deferred. He lived in it for 3 years, and then he sold it. Because he'd lived in it for 3 out of 5, he got to take 60% of the gain, tax-free.
Wow.
Paid tax on 40%, and he didn't mind that, because if he delivered pizza for Domino's, he was going to have to pay tax on that anyways. But where do you think he moved, David?
You tell me.
Next door to his next property, and converted that into his primary residence.
So now he's building a portfolio, a localized portfolio.
And every time he sells one, a percentage of the gain becomes tax-free. That's what you can do with retirement. Okay, now, nobody ever gets this question right, but I'll still give you the chance. What do you think the 4th D of 1031 investing is?
Defer?
Don't say defer. I wasn't quick enough. Darn it. It's not something you normally think of. It's die. And nobody wants to think about it. We're not enjoying thinking about it. We don't want to, but we're all heading that way anyways. When you die, the real estate that you own goes to your heirs at what is called a stepped up basis. So they inherit it as if they paid market value for it on the day they died, on the day you died. You don't pay the tax. Your estate doesn't pay the tax. Your heirs don't pay the tax. The tax really does disappear. So recap that. You can start with your first property. Do it smarter than I did. Start with your first property and continue to defer tax your whole life. You can do your 1031 exchanges in any market that you find, anywhere you find, of any type. You can adjust to life events that cause you to want to become more passive, more active, develop family memories, retire. And finally, when you die, the rest of that deferred gain becomes tax-free. That's the life cycle of a 1031 investor right there.
Wow. And okay, there are a thousand things I want to unpack there. There are a couple limitations here, right? I mean, as you say, the 1031 exchange itself is not applicable to your primary residence, right? This has to be an investment property, a commercial real estate investment, as we would say, right?
Yeah, I would say let's not call it commercial, because what all the realtors listening to know that as a particular sector of real estate. There's industrial, commercial, residential, and raw land. But rather, let's say it's got to be held for investment, but it could be any one of those types. But you're absolutely right. There's also one additional limitation that catches a lot of people. This is not available for fix and flips. What the IRS means by investment is you intend to hold it. Now, they don't have a statutory holding period. Usually a year is really safe, but there might be times when less than a year is appropriate. But your intent has to be to hold it. Now, what our fix and flip friends will do, because I've got a few folks now that they'll do 30 or 40 exchanges a year. On every property, they've owned it more than a year, but they're fix and flippers all day long. But what they did is when they bought their first property, they held on to it, they put a renter in it, and then they refinanced it. They used the refinance money, tax-free, to go buy their next flip property, while they reevaluated the property that they own. Well, by the time you've got 2 or 3 of those under your belt, you're safely able to 1031 exchange all those properties that you've owned for a year, but you're still continuing to feed your pipeline from the refinances. So it's a great model for fix and flippers. They just got to slow down a little bit on that first one.
Right. Well, and the other piece of this that I think is worth noting is that there is a time limitation to the 1031 exchange itself, right? So tell me about sort of how much flexibility there is between the sale of property A and the purchase of property B.
Yeah, this is the one that scares people the most. It's one of those things, though, where, like, if you've ever been on like a team building exercise, you go as a group and you're a bunch of idiots standing up in the mountains, climbing poles and going on raft lines and all that kind of stuff.
Yep.
If you've ever done that, the one thing that the counselors will always tell you is that the perception of danger is far greater than the reality. So go ahead and jump off this cliff. You'll be fine. That's the same with the 1031 exchange, because it starts with the closing of your sale. From that date, you have 45 days to identify your potential replacements. That's it. After day 45, you're stuck with what's on that list, and it can't be changed. So yeah, right away, everybody says, 45 days, I can't do that, that's not enough. Well, I mean, even in our worst of times, when it was such a total seller's market, like 2021, 22, we were still seeing 93% of our clients complete 1031 exchanges. So 45 days, that's a month and a half. Feels like it's short, but it's not as short as you think. But there's also ways you can mitigate that. Like, why do you wait till you sell your property to start shopping? If you're planning 3 months before you sell it, you're identifying your markets, you're owning in your team, you're locating properties you like. And it's actually fine to go under contract for your new property before your old property closes. So what a lot of people don't think about is, if you can get a contract for the sale of your old property and immediately get a contract for the purchase of your new property, so that you close your sale and a week later you close your purchase. Well, not only have you mitigated all the 45-day issues, but you just restarted cash flow that much more quickly. That's a huge benefit. Now, you've got a total of 180 days to close on the new property. That's not nearly so bad. Just about everybody doesn't have any problems with that. The 45 is scary, but remember, the perception of it is far worse than the reality.
Okay. Interesting. So talk to me now about how you think about what I would say is the first D that we're often discussing at Equity Multiple, which is diversification. How do you protect your investments in this investing context against essentially throwing all of your eggs in one basket or too few baskets?
Great question. I think that there's both a macro and a micro diversification that are necessary to make a successful life. Now, take this with a grain of salt. This is just Dave saying Dave things because I'm just a person named Dave. And
we should name the podcast that. Dave saying Dave things.
There you go. I like that. So, as a real estate investor, there are those people who say, that's all I want to be. That's all I'm going to do. That's who I was. I hated stocks. I hated equities. They made my head hurt. But so I just was in real estate. Well, as I'm growing older, I realized that because real estate markets come and go, the time isn't very predictable, but the cycle is absolutely predictable. That there's going to be moments in my life where I don't want to be buying and selling real estate. I want to be sitting on the sidelines. And if all I have is real estate as my investing bucket, I'm going to be in trouble. So I love to talk to people who are building their real estate portfolios using a W-2 job. You're credit worthy. You're building from two different buckets. Gosh, was it Napoleon Hill that talked about the need to have 7 different streams of income in his book, Think and Go Rich? I think that's right. So the idea is you get a job, you invest in real estate, you invest in more real estate, you're diversifying on what I would call a micro level because it's all still within real estate. But or fixed asset real estate. But then there's also the macro level. Whereas I've grown older, I realized that, okay, there is some benefit in the equities markets. There's benefit in things like investing passively with other people doing real estate or real estate-like things, investing in notes, investing in things like oil and gas, mineral resources, because all of those have different cycles. Sometimes they're contra to real estate, which is beautiful because you can sell real estate when it's high, buy oil and gas when it's low, and ride that up and then do the opposite. But yeah, I totally agree with you that it's in the diversification, whether it's in numbers of real estate or whether it's in not just investing in real estate. You and I were talking before the show about the idea of syndications, crowdfunding, passive investing. I think all those things are huge. And I've started to move into some of those as I've converted my real estate portfolio. Now, because of the first D in my world, which is defer, there's some very special ways you have to do it in order to keep that tax deferred. Yeah. So in a typical, what we would call a syndication, where a syndicator puts together an LP for a large real estate purchase, and that they bring on passive, partial member investors. You cannot 1031 exchange from the sale of real estate into one of those, typically, because the 1031 exchange is selling real estate and buying real estate. And you're not buying real estate. You're buying a membership interest in an entity that owns real estate. So you've got to look for special opportunities. One of them is where the syndication will actually allow you to buy a tenant in common interest in the real estate that they're owning. So you sell a piece of investment real estate, and then you buy a percentage of their real estate that the syndication owns. So the syndication is an owner, you're an owner. Now you continued to defer your tax, and you simply have an operating arrangement with the syndicator where your interest as a tenant in common are enfolded into the operation of the asset as an LP. Does that make sense?
Absolutely. Fascinating.
Now, the problem with that is typically that most normal syndicators, if they've got the ability to do that, they're going to require, because it's a hassle, there's some hoops they got to jump through. They'll usually require a $500,000 or $1 million minimum. And someone selling a $400,000 piece of property is going to have that kind of scratch. So what could they do? Well, one other option is to do your 1031 exchange. So let's say we were selling a property for $500,000 and there's $200,000 in loan on it. Your responsibility to defer all tax is to buy $500,000 in real estate using all $300,000 in proceeds. That's another requirement of the 1031. So what if you took $50,000 and you went and used that as a down payment on a $250,000 rental property? And then you took the other $250,000 and used that to buy a rental property with cash. Now, you've already performed one act of diversification, haven't you? You got two assets. One of them's free and clear, so it's out of harm's way. Just keep the lights on and rent it for what you can, and you're guaranteed cash flow. The other one is making the arbitrage and the leverage of your internal rate of return because of the debt. So, but you want to go further. So what you're going to do is take the free and clear property and do an immediate cash out refinance. Take out $200,000. Now, that $200,000 is tax free. So where are you going to put it? With your favorite syndicator named David, who's going to let you invest that. And because it's not 1031 money, it's going right into the LP. So it's a very simple process. So you do one 1031 exchange and you end up with two pieces of real estate and an investment in a syndication.
Right.
Dude, that's powerful.
Incredible.
Because especially there's no tax paid anywhere in that process.
Wow. Okay. My mind is spinning. There's so many things here. And I want to be respectful of your time. We're just about at the end of the discussion here. I wonder if you could just help me think this through, Dave. Let's say that I am currently in a place where I'm dabbling in real estate. Maybe I've invested in some REITs or some funds. You know, I have this experience of starting to read the educational material, starting to listen to the podcasts. And I'm just bumping into this concept of the 1031. Are there missteps that you think people take from this point that you might counsel them against? What are the things that people need to look out for before they can end up living on the sailboat of their own?
Just knowing about the 1031 exchange is your first step, because you're not going to have to worry about it till you're ready to sell an asset. So if you're in REITs, if you're in funds, that's awesome. Sooner or later, you're going to have to begin to develop a brick and mortar portfolio. But you got some time to do that. So, okay, it's shameless, but the very first thing I would do is buy my book. It's called Lifetime Tax-Free Wealth, The Real Estate Investor's Guide to the 1031 Exchange.
I love it.
It really was a bestseller, I think, in India for about 2 hours a year or two ago. Now, it's actually, you know what I love? I really tried to write a book that wasn't just a nuts and bolts, here's how you do it, boring kind of thing. I used case studies from our real clients over the years to show here's how this enlisted serviceman used the 1031 exchange throughout his military career. Here's how this couple married while they each had their own house and started a real estate career and ended up 1031. Here's how my realtor was able to retire on the beach as an investment and never pay tax again the rest of his life. Here's how these investors in Greenwich are now on their third generation of never paying tax. So I tried to put those kind of things. That is where you want to start, because you want to find, everybody's going to have an idea or develop an idea of what they want to do. We developed the idea, the Minneapolis city girl, the Kansas farm boy living in Colorado, decided they wanted to live on a sailboat on the ocean. Go figure, but that's what we wanted. So
Right.
What did we do? We went and found the people who had done that. So if you're discovering, I want to invest in real estate, great. How do you want to do it? And then go find those people and then figure out how the 1031 exchange can fit into that to ramp up and leverage up those results. Because the 1031, yes, it's a strategy, but the 1031 is not going to determine how you invest, where you invest. Those are all choices you're going to make. But no matter what it is, the 1031 is the tool that will help you maximize that return.
Are there any chapters in your book that discuss how to navigate a 56-foot sailboat into a harbor you've never been to before?
No, but you know what's funny is you asked the question of, when did I ever say this was a mistake?
Right.
At the very beginning. It was on a trip to the Dry Tortugas, which is about 80 miles offshore from Key West. It's one of the nation's most undervisited national parks because you only get there by water. And to this day, that area from the coast of Florida to the Dry Tortugas, which is called the bad place because it's notorious for storms coming up. And one night on a passage overnight, we almost hit a party yacht that didn't have anybody on watch. Our microwave fell off the shelf. We broke the mainsail. We broke the mizzen mast. And I finally just went to bed and said, Vicky, if we die, don't wake me. And when we got to the Dry Tortugas, we were silent for like 2 days in shell shock. And then finally I just looked over and I said, hey, Vic, I did not like that at all. And she said, I didn't like that either. I said, we still have to go home. Do you think we should buy an RV instead? She said, I think that would be a great idea. 2 days later after that, after 2 days of sun and snorkeling and spearfishing and the water around us, we said, okay, we made the right decision. So yeah, there's always going to be those moments.
Incredible. Incredible. Dave, thank you so much for your time today. I really appreciate the conversation. It's been incredibly educational.
I enjoyed it greatly. Always available for a part 2. If you ever want to sit down, we can go a little deeper into the nuts and bolts on some of these things.
I'd love to. Thanks so much. We'll be sure to put some links in the show notes so people can find your book.
Yeah, and please do come find us at the1031investor.com. There's a YouTube channel as well. So it's the same voice, but it's broken up in a very short time, so you won't get bored.
Beautiful. Thanks again, Dave. Appreciate it.
Take care.
That's it for this episode of Multiple Perspectives. Thanks again to Dave for joining me. If you enjoyed today's discussion, I'd encourage you to follow our show or subscribe to this channel or sign up for an account on equitymultiple.com. Any of these methods will ensure that you will know when we release a new episode. If you want to hear more about what Dave has to say about personal finance or real estate investing, you can find links to his works in the show notes for today's episode. If you want to learn more about the real estate investing opportunities that we have on the Equity Multiple platform, you guessed it, we've got links for that too in the show notes. Thanks for joining me once again here on Multiple Perspectives. I'm David Lofgren, and as always, you can let me know what you think of the show via our email, multipleperspectives@equitymultiple.com. See you next time.